A central bank digital currency, or CBDC, is a digital national currency which is created, monitored, and managed by a government. In the case of the United States, a CBDC would be a digital form of the US dollar. Like paper dollars, a CBDC would be a liability of the Federal Reserve. But unlike paper dollars, that liability is more than symbolic. So a CBDC would offer neither the privacy protections nor the finality that cash provides. In fact, it's precisely this digital liability, a sort of digital tether between citizens and the central bank, that makes CBDCs distinctly different from the digital dollars that millions of Americans already use, like credit cards, debit cards, prepaid cards, and payment applications. Currently, when consumers deposit money into their bank accounts, the deposits are liabilities of the banks. In other words, a bank owes a customer the money deposited in that customer's account and is responsible for transferring it to other banks on request. In the case of a CBDC, however, the money would be a liability of the central bank, that is, the government, in the case of the United States, using the Federal Reserve, would have the direct responsibility to hold, transfer, or otherwise remit those funds to the owner. This feature creates a direct link between citizens and the central bank, a radical departure from the existing American system, in which private financial institutions provide banking services to retail customers. Proponents argue that a CBDC would allow the government to fine-tune the economy. For instance, the government might try to control inflation or encourage consumer spending by directly increasing or decreasing the amount of money in people's bank accounts. They could do this by imposing higher fees on account holders when they want to reduce the money supply, or transfer more funds to people when it desires to boost spending. CBDCs also give the government more power to monitor accounts in real time for fraud or money laundering, and directly allocate funds to citizens who receive government financial assistance. However, in order for these benefits to be realized, using a CBDC in this manner would require a ban on all private monetary alternatives, including cash, such that Americans must directly depend on the federal government to receive and maintain their funds. It would also mean that private banks could no longer rely on private deposits to make loans. The risks of a CBDC are the flip side of its possible rewards. If the government can easily put money into an account, it can take the money out. In order to directly regulate the economy, the central bank could literally restrict the amount of money that people can access in their personal accounts. Every transaction would be monitored by a single federal system, allowing the government to see and, if desired, control where money is spent. The government can already monitor digital transactions, freeze accounts linked to criminal activity, and sanction commerce with hostile nations. A CBDC would make these activities quicker, easier, and more decisive, but national digital currency is not necessary to prevent fraud or crime. Apart from logistical questions about how a CBDC could be implemented, Congress and informed citizens should think carefully about the intended and unintended consequences of such a system. If cryptocurrency is the wave of the future, should the government have its own version? The Federal Reserve already sets monetary policy, but should it become a part of the government and have complete power over the money itself, turning money into a vehicle for societal control? In order to eliminate fraud and money laundering, is it a good idea to relinquish all privacy in transactions? Would a CBDC enable a party in power to weaponize the financial system against their political opponents? Join the conversation in the comments below.